Gold's relentless surge higher continues. Seldom in my 44 years of participating in this market have I seen a rally so strong and so solid, which begs the question, is the canary in the economic and geopolitical coal mines singing? That is the $2,335 question. Today, Friday, April 5th, 2024. This is my gold market commentary. Let me share my screen. Coal miners used to take canaries down into the mines with them. If noxious gases were present, the canaries would keel over, telling the miners it was time to get out. Usually when gold makes a run like it's just made, something is afoot. Something not good is afoot. So in this gold market commentary, we're going to drill down on what's been going on. Gold is punched over 2,300 today, and silver is surging higher too, finally playing catch up with a bit of a vengeance. Yet, gold's record high is defying a stronger dollar and stronger treasury yields over the last couple of weeks. So what's driving this strong breakout rally? We're going to go over the latest charts for the US dollar, yields, gold and silver, and some others as well. And we're also going to discuss the premium compression that we've been seeing due to the higher gold price on vintage US $20 gold coins. The premiums today are unusually low. We seldom see them this low, which makes a great opportunity. So let's take a look at our chart for gold. Here's a one-year gold chart, and you can see the rally that started at about 2040 has been really, really strong. We ran up to just about 2,200. We've had a modest price correction, and over the last 2 weeks, we've made a really strong run to 2349 in the futures market. And this rally has just been relentless, with gold surging almost every day for the last 2 weeks to a new record high at 2335 spot today at the close. It's really, really strong. So let's look at the dollar. This is a one-year dollar chart. And you can see over the last month, the dollar has been strong too. And to see gold make the kind of run it's made with a stronger dollar, although the dollar is still range bound, that's really, really unusual. And treasury yields are rising as well. This is a one-year chart of the 10-year treasury yield in red and the 2-year in purple. And treasury yields have been grinding higher as well over the last month, and especially over the last couple of weeks. They've been choppy, but the US economy continues to be resilient. Inflation remains sticky at about 3.2% on the CPI, and it's holding. It's not really giving much up. We just had a new jobs print today for March of 303,000 new jobs, and the last 2 months were unusually revised up 20,000 jobs. And that's good for the US economy, which makes market participants believe that the Fed may not be able to cut rates the anticipated 3 rate cuts this year that everyone's been salivating about, and which should have been the gold driver for this year, but that's not happening so far. So what's making gold run higher and so hot in the face of a bit stronger dollar and stronger yields, which is very unusual? Well, these are gold's normal price drivers. An inverse correlation to the dollar and treasury yields, well, we just discounted those. Currency debasement and inflation, yes, that's ongoing. Inflation's sticky, but it's not running hot. But the US economy remaining strong, some are concerned that we might get a bit of a pop in inflation. Economic instability, not so much. The US economy is really the only beacon of economic health in the globe right now. The rest of the world's pretty weak. So it's really not economic instability. Geopolitical instability, yes. The war in the Ukraine continues, and the Israeli-Hamas conflict continues to spill outside of Israel's borders. We've seen Israel about a week ago take out an Iranian general at a Syrian consulate, which is a big no-no. And Iran has vowed revenge. And just in the last 48 hours, some relief workers from the World Central Kitchen were killed by 7 people were killed by an Israeli strike in the Gaza Strip. which has really created a political turmoil for Netanyahu in Israel. And President Biden may finally be reacting to continued support to Israel unless Israel provides food and medical supplies to all the displaced civilians in the Gaza Strip. So that could be a contributing factor to gold's surge. We're also seeing surging U.S. debt. Well, that's a given. That's just going to continue to happen. Central banks have been record buyers of gold, yes, but that normally wouldn't create such a run that we've had. So what's happening in driving gold higher? Well, some of the above. Let's look at what's happening with central bank gold buying, because there's been a lot of news stories that you don't normally see about that in the last week or so. This is a headline from Bloomberg from March 7th, earlier in the month. China splurges on gold for a 16th month as price hits record. Now, that's when gold started to really take off. The real thing in China is Chinese investors have been hammered by their property market and their stock market in the last 2 years. So they're turning to one of the only trusted investments that they know, gold. So the Chinese populace could be buying gold at record levels, and the Chinese government could be behind some of this as well. This rally does strike or smack of a sovereign nation buying, because it's been really big and consistent. This shows central bank buying over the last year by the different countries. China bought 225 tons in 2023, Poland 130 tons, Singapore 76, Libya 30, the Czech Republic about 18, and so on. In 2023, central banks bought 1,037 tons of gold, which is just shy of 2022's record of 1,082 tons of gold. Let's put that into perspective. Since 2010, central banks have been net buyers of gold. Central banks aren't normally net buyers of gold. Between the 1980 peak of gold at $8.50 an ounce into the 2008 and 2009 GFC, central banks were mostly net sellers of gold. The great financial crisis turned that back to positive buying by central banks. Instead of selling, they become buyers. Now, over the last 10 or 11 years, most of those years, the peak was about 500 tons of gold. But since the Ukrainian war and the U.S. sanctions against Russia, central bank buying has surged in 2022 and 2023, as you can see on this chart. And that's the reason for it. And it's starting to make news in the mainstream press a lot. This is a headline just from today on MarketWatch. Gold hits another all-time high as investors take cues from near record buying by central banks. And there's a quote in here that I think is especially pertinent that I'd like to read to you. Nicholas Colas, co-founder of DataTrek Research, said in a note Thursday that his company's positive view on gold stems from the belief that foreign central banks will be consistent buyers for many years, even as the pace of purchases has been slowing so far in 2024. Ever since Western sanctions against Russia in the wake of its 2022 invasion of the Ukraine, the value of holding gold reserves rather than treasuries has become more obvious to many governments. He explained, both assets are priced in dollars, highly liquid, and respected as a long-term store of value. Physical gold, however, cannot be confiscated or subjected to sanctions once it's housed in a local vault. So we've seen a real surge in what normally very conservative central banks' behavior is, and they're turning to gold. And there may be more behind this, but this makes me laugh. I'm going to share this with you. In news of the weird, Zimbabwe launched a new gold-backed currency. This is from the BBC just this morning, the ZiG. So they've been suffering from rampant inflation. Their main currency has been the dollar, but now they're turning to a gold-backed currency. And that, of course, is the prospects for the BRICS nation that has been much discussed over the last year, year and a half. We'll see how this plays out. I don't think Zimbabwe is behind this rally, but I do think this really big gold rally has been driven by both central bank buying and hedge funds and big investors. Now, this could be some momentum buying going on, could be algorithms too, but it's been really a rock solid rally. And I don't believe I've ever seen one like this in my 44 years. Let's look at the candlesticks, which show the open, high, low, and the close for this market over the last 6 months. As you can see, resistance tends to turn to support when a market moves above or below a resistance or a support level, and vice versa on the way down. Now, we did have that run in December up to 2152 on a spike, as you can see over to the left, but that didn't hold. But that was typically the top from before. From support at about $2,000, gold has made this run up. Once it crossed the 50-day moving average at about 2040, this rally moved in earnest. It got up to about 2,200 when we made our last video alert to you. And that wick at the top of that candlestick at that time told me that, hey, maybe this rally was due for a little bit of a break. And that's exactly what happened. We got a pause and we went sideways for about 2 months, but we held support, for about 2 weeks, and we held support at 2150. And over the last 2 weeks, we've taken back off again with a vengeance. And you can see there's only one real down day, which was yesterday. I thought today, Friday, April 5th, would be a little weak, but we took off again on the back of the jobs report. But I think a lot of this is also geopolitically driven with what's been happening in Israel in particular. So there's a lot going on. This rally has been really strong. It's due for a bit of a pullback and some profit taking, but if that'll happen next week or not is anyone's guess. This has been one of the most sound, solid rallies I've ever seen, but it is due for a bit of a correction. But again, it's anybody's guess what happens next because the world is getting a bit stranger every day right now. Let's take a look at the 1-year silver chart. And as you can see, silver, which had been trading primarily between 22 and 25 for just about this entire year, has finally caught a real bid, surging from under 25 at about 24.75 on that correction a couple of weeks ago to as high as 27.52 today, setting a new short-term high. Silver is playing catch up with a vengeance. As I told you, it had the potential to do so. Now, with gold at over $2,300 an ounce, I still think silver should be closer to $35 than $25 an ounce. And that may prove to be the case over the next month or two. We'll have to see what happens. But silver is finally playing some catch up. Let's look at the gold to silver ratio chart. This is a 25-year chart, and you can see when the ratio is over 82, silver is cheap relative to gold. And when the ratio is 65 to 1, it's about even. And under that, gold is weaker relative to silver. Today, with the spot market at 23.35 for gold and silver at 27.52, the ratio is about 84.84 to 1, which is still high. You can see those two blue ellipses, which are the two previous times silver really played catch up with a vengeance during the great financial crisis and once COVID hit. Now, is this a spark for that kind of a rally for silver? Perhaps. Time will tell. But I do think silver, of the two metals, gold is going to continue to lead, but silver could really play some catch up here if it continues to catch a bid like it has. It will be more volatile than gold, so you have to be a little careful there. Now let's look at the vintage US gold coins that I mentioned at the top of the video. This is a picture from our website, American Gold Exchange, featuring the $20 St. Gaudens in mint state 64 condition, trading at about $2,520 today in volume, with its intrinsic value at about $2,250. That puts the ratio, the premium today at about 12% over to the right on the bottom in reddish pink. As you can see on this 5-year chart, that's just above a record low we set about a week and a half ago at about 9%. So this rising gold price and a sideways to an edging higher price for the vintage numismatics has compressed the premium of these coins. And it's not just the Saints in MS64. The lower grades, MS63 and MS62, are seeing similar premium compression. And the same thing's happening in the $20 Liberty sector, primarily in MS63 grades and lower. There's a lot of value to be had at a low premium in these vintage numismatics right now. When you go to the slightly higher grades of MS65 for the St. Gaudens and MS64 for the $20 Liberty, the number of survivors becomes a lot fewer and the premiums are higher, but they give you a better chance for appreciation of premium because of their scarcity. They give you more leverage. So for value shoppers who want gold for just the gold related value, the lower end numismatic 20s today are great deals. And if you're patient, you'll see premium expansion over time, like we've seen on the Saint and MS64, which has been as high as 40% in premium twice in less than the last year. So there's a real opportunity for vintage numismatic buyers today in the medium to lower grade mint state quality coins for the $20 St. Gaudens and the $20 Liberty. This is a picture I just love. Miners who actually loved their canaries and didn't want them to die, if they started to falter in the mine, they had these boxes that they could close the door on and open some fresh air for them. And that's what gold is in times of economic uncertainty or geopolitical uncertainty. It's a safe haven box for your savings. That's how you should think of it. So here's how you contact us. We're a national physical precious metals mail order dealer out of Austin, Texas. We're in our 25th year in business, and this is my 44th year doing this. And as always, I cannot thank our clients enough for the business and the trust that you place in us. We've been experiencing record buying and selling on this gold run, and we're seeing some big dollar trades. And there's a lot of value at stake, and your trust in us is highly appreciated by us. We know that our clients are our best asset, and without you, we don't have a business. So thank you so much for your time. And if you like what we're doing, please like our video and become a subscriber. So have a great day. Thank you very much.